In 1984, and now I'm going to take you to a bit of a sort of Lord of the Rings Silmarillion, if you're an aficionado type of scenario. So common law in the covered bonds universe is that in 1984 there was a conference at the Chiemsee. Dr. Hagen is nodding. He sort of seems to. So that is, and at that conference there was the first time where people were actually discussing an EU fund brief directive. That didn't come to fruition at the time. However, it was the birthplace of UCITS, so still something that we use today. That shows, it's about 35 years ago, and it shows that innovation can take a long time, but now we're in a place where it resonates also with the help of the ECBC from Brazil through to, from Sao Paulo to Tokyo to Wellington and globally. So that's a great achievement. I'd like to ask my panelists to introduce themselves. Claudia, we start with you.
Anything? No. Okay, my name is Claudia Baerdges-Koch. I'm head of debt investor relation at UniCredit, and my name is written wrong, but Bodo mentioned they were happy that they find the A, but the E is just like too much. So I'm here because, I was invited by Fritz, and who can say no to Fritz? Come on, yeah.
Okay, my name is Bodo Winkler. I represent Berlin Hyp. And at Berlin Hyp, I am responsible for the funding and investor relations.
Good morning, everybody. My name is Sascha Kullig, head of capital markets at the BDP and also responsible for sustainable finance at the BDP.
Good morning. My name is Franz Rudolf. I'm responsible for the financial credit research at UniCredit, focusing on covered bonds.
So we're going to cover in this panel covereds in the funding mix. We're going to discuss the new directive. We're also going to discuss the transformation into ESG markets. But one of the biggest innovations seems to be currently negative yields. So we'll start with the very mundane bit of the transactions that you two have done after the sort of summer break, or even sort of slightly during, and both went really well and successful. So, Bodo, since you were the first one out and you followed the week thereafter, maybe you can share some of the aspects and experiences that you had in connection with your trade.
Well, first of all, I don't like it to be called an innovation. In the end, it's nothing more than a reaction to what is happening on the markets, and a transformation of our funding needs to these circumstances that we find. Then again, it's not the first time that private institutions refinance themselves with negative yields. Berlin Hyp already did its first negative yield covered bond in 2016. There was another one in 2017. We were close to issuing one in July this year. In the end, it ended up happily with a 0.000% coupon and yield. But I think the new thing was now how deeply negative yield you could print. So of course, we were excited about this deal and very concentrated on that. We had a lot of conversation with investment bankers, with investors before coming to the market. And in the end, our feeling this will work was proved by the outcome. We managed to have an order book of 1.2 billion. We're able to print a 1 billion bond at the tight end of the guidance of flat to -2. So that was a positive outcome, setting positive sign for other issuers to do the same. and to do more normal funding to really what they need. Because what we've seen before that was with yields on the market decreasing, every new issue went longer and longer. Both of our institutions experienced exactly that. And in the end, you have to see this does not naturally match your assets, at least in our case, being a commercial real estate lender. And you have to come back to normality then somehow. Therefore, very pleased with that. Not pleased at all with the environment that we have to act in, because, to be honest, for us as a bank, it's without saying much nicer to offer some return to our investors and not to ask them to bring money just for storing their money with us.
Oh, that's appreciated. Claudia, what were your experiences in your, I think it was a 4-year transaction?
Yes, correct. I fully agree with Bodo, because I think it's no innovation, but we just simply have to react to the market. And when the yields are there where they are, we have to react. And as Bodo mentioned, so we've done, or we issued as well, the 20 years one, which is perfect match for our assets as well. And honestly, if I just think we've done this deal in 2019, and it was a 1% coupon. And nowadays, if we would issue the same bond, it would be just like fragments of yields left. This is unbelievable. And yeah, going for a 4 years one was just like, okay, it was proven, it works. But still, I'm happy not to be investor, to be honest, in this situation, because I know some are still looking at, or their view on a bond like this is, okay, it's XYZ basis points pickup versus KfW or versus Bunds. Maybe if this is the benchmark, they're just like been treated or just like benchmark to, fine, it works for them. I think this is the reason why we haven't seen so many bank treasuries in the bond, but more just like financial official institution and central banks in this case. And this is maybe the change. And even we said, when we were going for the 20 years one, we said, when we would be looking at an LCR trade, what would we go for? And it would be duration. So we were going, or decided to do 20 years one. And this one is a perfect one, because we simply will just pay back the TLTRO, because we even funded ourselves cheaper. It's strange.
That's amazing. Franz, the writing's on the wall for Thursday. What is the expectation?
Well, I think there are a couple of aspects that are important in that respect. I mean, first of all, of course, the level of negative yield is crazy, no doubt about it. On the other hand, as you already mentioned, it depends a bit on what you compare it with, right? Relative to what? Compared to Bunds, it's still almost 40 basis points pickup in the 5 to 7 year maturity range. If you are a bank, you might swap it back to Ionia, which also offers you some 15, 16 basis points. So it's still attractive. So it always matters what do you compare it to. And we're in the lucky situation that all the other asset classes tightened in so much as well. So around 50% of the corporate bonds are negative yield, right? Even the financials in the iBox are 50% are in negative yields. That would be, of course, a different picture if they would all have a nice coupon, and then you only have the fund brief trading in negative territory. Of course, the important fact is what the investors will do. And if I hear how deep can it go, I always get reminded of the Bee Gees song in the 1970, how deep is your love, right? How committed are investors to the fund brief? And I think the commitment is pretty high because they know the quality, they know the reliability, they know the innovation with green fund brief, et cetera, et cetera, et cetera. So I'm really not scared that much that the investors will stay away. Of course, different investor classes might reduce, but overall, I think it's still an attractive product. if you ask me what to expect on the QE, of course, tomorrow will be the showdown, the first one at least. So I can really say anything on the expectations. Of course, market expects something between 300 and 400 billion of QE for 9 months. I think that's quite a big number, actually. And if you look at markets, on the 3rd of September, I think we had a 10-year bond of minus 74 basis points. That was reduced now to minus 55, something in that region. So it came back a third. So I think the market also realized there might be, or there might have been a certain overshooting of expectations, which is now currently corrected. So I'm not in a position to tell you what the announcement tomorrow will be. But I think there is a realistic chance that it might be less than the market expected a month ago.
I think that's something that we would concur around as well. If we look at the yield discussion versus the QE discussion, and asset purchase program is reintroduced. There's going to be some monthly purchases in cupboards again, over and above sort of net new purchases. How much can we sustain? Is it sort of 2 billion, 3 billion? Is that still all right? When we go into 5 billion, does that then harm the market? So what would be your take, also from the issuer's perspective, around the impact of a CBPP4? I think it's then the number. What is sustainable and where do you start to worry? Bodo, do you want to take this?
To be quite clear, we at Berlin Hip, we don't want that, but we didn't want CBPP3. Nobody listened to us then, so probably nobody will listen to us now. I think CBPP3 did a lot of harm to our covered bond market, but it was not able to destroy it, finally. What we saw when the program somehow approached its preliminary end and was about to start only in this phase of reinvestment. Order books got bigger. Again, more investors came to the single transactions. Spreads increased, making the product more attractive for more investors. So that was a good development then. And if there was a CBPP4, it was just turn back everything. But even in a worse environment that we witnessed when we started CBPP3, because yields are already lower now. And I think it would do a lot of harm again. And if you now imagine on top of these yields you see in the market, you also see a decrease in spreads, bringing us back maybe to these areas of minus 20, I think was the lowest that we achieved in the primary market. Who should buy that? Then the ECB should go there and say, okay, I will not restrict my order to 50%, I buy 100%, because I cannot think of other investors who are willing to pay that.
With us, we were so happy that the market was more or less coming back to normal, that we've seen names which we've missed for quite some time. And yeah, I think this is really a horror scenario, especially as Bodo mentioned, because the yield environment this time is completely different to the first one. And I was just thinking, oh wow, which program will be in place when I retire sometime? So if it will be number 10 already or whatever.
So we're sending a strong message to Ed. I can't see him at the moment, but I've seen him yesterday evening. So, oh, there he is. Ed, don't overdo it, please. Franz, do you think from the experience looking back that the damage of these programs is a lasting one? Does it really sort of impact the investor franchise that issuers and dealers are catering for in the long term, or is it something where investors sort of tend to come back quickly? I mean, we've heard some strong views here already.
I mean, we had times when the asset purchase program was 80 billion, right, a month, and then it was reduced to 60 and 30 and 15. So we coped with 80 billion a month. Of course, we will also cope with whatever figure comes up. The question is for how long it's going to take. We have seen that some of the asset managers, some insurance companies, etc., retreated from the market when it was at their lows, because they said they don't see much value in that. They came back when yields started to rise again, and I'm confident that they will come back once that is over. But of course, the longer it takes, the more damage it will cause. So I'm hopeful that either we don't get a CP, a fourth covered bond purchase program, or it's going to be a short one.
Sascha, you want to jump in?
Yeah, if I just may add, the crowding out is a severe problem going far behind this covered bond industry, because all investors, for instance, pension funds, are forced to go into riskier assets. So my personal concern is that the next crisis will definitely come from that side, and then we are really in a big trouble if you lose your pension. So the ECB should be careful about this.
In terms of the funding mix, we've mentioned this in the beginning, when you also have, against this backdrop, do you see a changing role of the covered bond in the funding mix versus senior preferred, senior non-preferred? Also, if the euro, if the common currency doesn't sort of deliver what you like in terms of investor diversification at some point, would you do more US dollar issuance? So what's your current feeling when you look sort of into the next 12 months, 18 months?
As a specialized mortgage bank, Fundbrief will be the main funding resource for us, no question at all, and it won't change. But I think it's a perfect match that we have, just like Fundbrief, and we can issue as well in euros, in US dollars, and in our case as well in Swiss francs, as we have Swiss assets as well. So there's a diversity where we can reach, and in contradiction to any real or pure commercial mortgage lender, we have the retail assets even out to 30 years. So we have a bigger range where we can issue, and this might be quite helpful, but no question at all that the Fundbrief is the main funding source and the most important one.
It's a little bit boring that you invited both of us in the end, because I can only confirm what Claudia said. As a specialized mortgage bank that does nothing else but lending for real estate, of course, Fundbrief will always be our number one funding instrument. It has been like this for 150 years now in our special case. And I'm pretty sure it will remain as it is. But of course, you have to think about how to offer an attractive product and diversification into currencies, for instance, where you simply have other interest rates than in the euro area, is one of the options.
So more or less, it's a proof what Dr. Hagen said. So it's no time to retire for the Fundbrief.
No, okay. Then
Fritz, if I may add from an analyst point of view, I mean, given the squeeze of interest margins, I think it's even more important to use a covered bond, the Fundbrief, as a funding tool in order to secure some of your margin you have in your mortgage loans, right? So in that environment, I think the Fundbrief as a funding tool will become even more important for banks. Of course, not only for mortgage banks, but also for other banks. So in that respect, it's helpful. But on the other hand, of course, you need someone to buy it. So the investor side is, I think, the crucial point.
Then let's move on to something even more interesting, something really riveting, something that grabs our attention and where we can't actually go to sleep because we think about it so much, and that's the new directive. I imagine that Boris Johnson would say something like that around the new directive. I'm not sure whether that, but you know, it's the last time. We're not going to mention Brexit. So, Sascha, the new directive will facilitate possibly the issuance of soft bullets, soft bullets Fundbriefe. We also see that in 2024, by 2024, there's an equivalence regime introduced for third countries. Is this a good development in terms of when you look at the fund brief, the German fund brief, the brand that also the VDP stands for? Is this increasing competition, or are you sort of worried that a soft bullet or anything along those lines would sort of water down the trademark? Do you have a view on this?
Well, first of all, we've been discussing with our legislator and regulator now, I guess, for 5, 6, 7 years about introducing a kind of soft bullet or maturity extension in the German fund brief law. So yes, of course, we think this is a very useful instrument because it helps investors in the sense that you could avoid with this kind of instrument an insolvency of the cover pool immediately after the issuer's insolvency, at least if it's because of a liquidity gap. So having said this, the directive, of course, allows for an introduction of maturity extension. Whether we will see this kind or whether we will transpose this into the German fund brief law has to be seen. I'm not the legislator, but of course we would like to see this possibility in the German fund brief law, and we are quite confident that we will get this within the transposing of the directive into German fund brief law. So hopefully, yes, even in Germany, it will be then possible to have this kind of soft bullet structure. The difference will be that it won't be on a contractual basis in the sense that we will have this in the fund brief law. So either you get it for all fund briefe or you won't get it at all. This is very important. So it shouldn't be the choice of the issuer whether they go for hard bullet or soft bullet. So it has to be clear by law. With regard to third country equivalence regime, of course, we are not concerned about competition. The German fund brief is a very competitive product, and we always have supported third countries in developing new covered bond products. I'm a member of the Global Issuer Working Group within the ECBC. This is a very interesting work, and we are happy to support those countries. And in fact, we also learn from them something. So yes, we support this. We don't fear this. But having said this, this is just one side of the coin. The other side is that how are covered bonds treated in those countries? So if issuers from those countries want to get a preferential treatment in Europe, which is fair enough, which we support, we should talk about if and how we can get, how European covered bonds can get preferential treatment in those countries. This is, in my view, a very important discussion.
Bodo, are you keen to issue soft bullets?
We are keen to issue fund brief, and if they include a possible maturity extension, I think the VDP does not want us to speak of soft bullets in the end, and they have their reasons for that. Then it's like this: we will always issue fund brief as they are described by law, and therefore it is not important what we are keen to do. It is important what investors want to buy. And if we now look on the covered bond map, which has become a worldwide map, we see that there are only very few countries left where the legal requirement is issuing hard bullets. So I think it has become a totally accepted feature within the investor base.
But to you, it is more sort of, it's a detail, it's a marginal issue rather than at the center of the attention.
But you still have investors left where you get the feedback that they prefer hard bullet. But in the end, as Bodo mentioned, it's a worldwide map, and we will follow the law by issuing fund briefing.
Let's move to, I guess, the topic that most people have on their mind when they think about innovation. We've co-hosted together with Carsten 2 weeks ago an event at the Frankfurt School of Finance, and also Slavko was there, and she made a very strong point about the global initiative by banking supervisors and capital markets regulators to include climate risk as a feature in financial risk metrics. Now, the VDP, together with all the partners in the institutions, they've come up with minimum standards for green fund briefer. Can you, Sascha, talk us a little bit through where does this come from? How does this tie in with the work of the EMF and also with the EU taxonomy that's being worked through, and sort of what are you trying to achieve with this?
Well, first of all, the minimum standards for green fund briefer are a very clear statement that German fund brief banks are committed to sustainable and to green finance, that they want to contribute to the achievement of the climate goals. As we all know, buildings heavily play a very important role regarding CO2 emissions. So we all have to act here, and the German fund brief banks want to act now. This is the clear message, because sometimes we get asked, why don't you wait till the taxonomy is finished? The clear answer is we don't want to wait because we don't know when it will be finalized, both the technical screening criteria and the regulation on which this is based. So we wanted to act now. At the same time, investors ask for a definition of what is green and what is not green, even though we all know there are different shades of green, as can be seen by our ties or socks. We wanted to come up with a definition on both sides, a definition where we could deliver a definition on the asset side for buildings, for energy efficient buildings, and on the liability side for green fund briefing, because we are convinced that the fund brief or covered bonds as a whole are the perfect product here, because they bring together the borrower on the asset side, so be it a commercial borrower or the single family house, and institutional investors on the liability side. So this is the big picture. And when I say we don't want to wait, our member banks have acted already. For instance, those two here, they already issued green fund brief or ecological fund brief. They already offer green mortgage loans. So it was the logical next step to boost the segment by allowing all German fund brief banks to issue green fund briefer. And thanks to Bodo, we now have the trademark rights for this label green fund briefer. And our aim is, of course, that more fund brief banks will enter the market. At the same time, we want to give investors clear guidance that they can be sure if they buy a green fund brief, those green fund briefs fulfill detailed requirements. So we set detailed minimum requirements for the energy efficiency of buildings, and that is the core, or one core element of the green minimum standards for green fund briefer. And this is also the link to the energy efficient mortgage initiative, because we, together with our member banks, the pilot banks in this initiative, we further developed the European definition of energy efficient mortgage on a national level. And this is the core of the minimum standards, the energy efficient minimum requirements. In addition to that, we set other requirements. It has to be based on the green bond principles, of course. They have to be very transparent, the issuers. They need to have at all times eligible assets, at least at the same amount like outstanding fund brief over the whole lifetime of the fund brief. There need to be an external review. There need to be an impact reporting. So everything which is common and which is really important and good for investors is part of these minimum standards.
Franz, when you look at the market of green covereds, what is your expectation and what do you think are the main drivers for this? There is climate risk in financial risk metrics. There is the push, that's from the top. Then at the bottom, there's the push, legal push obliging people to build houses in a certain way and in an energy efficient manner. So supply and demand coming together at some point. What is your projection? How does this become, this type of issuance become mainstream?
Well, it's definitely here to stay, right? It's not nothing that will. It's just a trend that will, go away in a couple of years. It's definitely here to stay, and I think it's going to develop further. And of course, it's still a young market, and Germany has again proven that it's kind of proactively tackling that market. And on the covered bond side, 45% of the currently outstanding covered bonds are coming from German issuers, followed then by Norway and Spain and South Korea. But I think it's important that you have the transparency and the simplicity, that it doesn't get too complicated for the investor to follow up different standards, different rating agencies, different names for kind of ESG bonds. I think there are around 10 names for kind of ESG bonds out there. So I hope that it's kind of stay simple or becoming even more simpler, because I think that is clearly needed for the investors to follow that path. And of course, the low yield environment currently, from my perspective, hinders that there is also a spread differential between green ESG bonds and non-green bonds, because if you're compressed that much, there's hardly any room for distinction. But I think in an other yield environment that might well be the case, and then of course you do have even more motivation to issue in that respect or buy as an investor. And I think from an issuer perspective, in the past couple of years, the first ones that actually used that product clearly had an advantage because they were able to shape the market. Now it will probably become more common. In a couple of years, I think if you, as an issuer, don't have anything that is green, ESG, whatever, in your toolbox, you will actually have a disadvantage.
The topic of the greenium seems to be something that we used to be discussing with issuers. Well, why don't you do an ESG trade? And then they would say, well, this is a lot of work and I don't see a benefit in terms of my funding spread. That's what some funding managers would say, looking at their mandate internally. So we seem to have moved beyond that. That's not a question anymore. So people, as you say, required in their toolbox. But looking at the supply and demand dynamics, also looking at the growth maybe in your on the asset side in terms of eligible projects and mortgages. What do you expect going forward? Is there a greenium that will be a constant feature of the market?
I don't like talking about greenium at all, because I think this is a discussion that is more or less 5 years old and has not led to any proper results so far. And I also think it is not important for what we are doing in the end. Why are we doing lending for green buildings? First of all, we think these are the buildings of the future. And that is not only because we know these numbers that everybody knows, like 1/3 of all the energy consumption comes from the building sector worldwide. Almost 40% of total CO2 emissions come from buildings worldwide. So we know our responsibility there very well. And we also see what our customers say that is in demand, and that is modern real estate, of course, and not so much old office buildings where you have to pay a lot for heating, for the ventilation, for whatever. So I think it is just going with the time. Then, on the other hand, we see what investors want. They want to invest in these products rather than in the conventional ones, and they want to help by doing this investors, issuers, and therefore lenders to rethink their business model and maybe to adjust it to what is needed at the moment. And I think I can speak for both of us at this time. We have understood this and just included it in our corporate strategies. When it comes to growth of the assets, the green assets on the balance sheet, at Berlin, we have set ourselves an ambitious goal. We have set in 2016 for the first time. By 2020, we have to have 20% of our total loan portfolio being green. That was really very ambitious. I'm very happy that by this date already we passed the 18% mark. So we still have more than 1 year, very confident that we will able to reach that goal. But then again, it will be the question to define a new goal, and this has to be ambitious as well. I think that is what I am asked by investors all the time now that you have advanced already to that stage. What will be next? And that is basically the discussions going on in our bank.
Yeah, as Bodo mentioned, it's no question. We started with the first sustainable in 2014. It's part of our business model and our strategy. And having own products in place for our retail customers, it's no question. And in the last months, we even just came up with a new product for the money market with green commercial paper. It's still that you develop your bank even further and have new ideas, and just get feedback from investors and find new demand. Yeah, it's part of the business. It will be part of the business, and there's no discussion.
I would like to add one more thing because you probably changed topics again to the VDP minimum standards from one of the issuers' perspective. I think this is really a big achievement because in Germany we had already 5 different issuers when we said we want to have a common standard. And that means, of course, 5 approaches that have at least little differences. I think in our cases it's very small differences, but with others was bigger, the differences maybe. And then I think is a great achievement to come to a standard in a relatively short time, because we only began to think about this at the beginning of this year, and it took us many sessions and other call sessions and then circulating papers. But in the end, we ended at a minimum standard that everybody is happy with. There is also one, I think is only a footnote, but that is very important. We will watch very carefully as German community what will be the end result of the EU taxonomy on buildings. We are very happy with what is there in place in the current draft version. I have to say that because with the first draft, we were not happy at all. So I think this is a very good step forward. And then when we have the final version, we will analyze carefully, is what we are defining in line with what the EU, as Carsten has said, has put to their dictionary, because nothing else it is, and do the best we can to align this with each other. I think that is very important.
Would you, Sascha, I'm going to get you into this. Would you then look at these minimum standards to be a model for other European or even global markets once the taxonomy is agreed?
Well, this has to be decided by each national legislation or issuer community, but I don't see any reasons why this shouldn't be adopted by other countries. We would be happy to support this, and it would be a perfect match to the Energy Efficient Mortgage Initiative. One final comment to the taxonomy and our minimum standards. one thing is very clear for us. This is a moving target. I mean, we have come up with a definition of what we consider green on the asset side and on the liability side. But of course, this has to be developed continuously, like the taxonomy. I mean, the taxonomy has now acknowledged that there need to be a transition period in order to achieve the 2050 climate goals. And this applies to the minimum standards as well. We set the bar not too high because we want to get more banks using this product, but certainly we will raise the bar over the time in order to achieve the climate goals. This is very important.
It's minimum standards. So everybody should think about the word minimum standard. Of course, every issuer is able to define in its own eligibility criteria aspects that go far beyond this.
So I hesitate to ask my final question to all four of you because the answer is already clear. When you look ahead, what are the main drivers of innovation in 2020 in your view? So we come from a great tradition. Looking ahead, I had three things written down. So I had monetary policy. You already said now that that's not even part of innovation. So that was really a non-starter in a way. Then new directive, rolling out sort of good ideas from different pockets of covered bond laws locally into the directive, and then spreading those good things, or is it the green revolution? So amongst the three, monetary policy, directive, and green revolution, what would be your pick?
Surprise, it's green.
It's green plus digitalization.
Yeah, I mean, certainly not a covered bond directive, because we have to change something in our fund brief law, but we don't have to change it fundamentally. So that's definitely not the case in 2020. It's hopefully green, because I'm convinced that fund brief banks and actually all issuers need to have a product in place, as you mentioned earlier, in the future. They need to offer green products. And I agree with Bodo, digitalization becomes very important, mainly on the asset side, but also on the liability side. Whether we will see innovation there already next year, I don't know, but certainly this is the future also for the liability side.
Well, green will be one part, but I think innovation has to do to adapting the system to the challenges that are ahead. And I think there are going to be quite a number of challenges ahead. So we can just, we have to keep up with innovation to cope with that. But I'm confident that we will overcome that, because if not the covered bond world, who else should withstand those challenges?
Sorry to interrupt, but I think social is also a very, very important aspect, because it's something what we were talking about as well in the working group, to find standards there as well for the national hub. And I think it will become as important as green as well, due to social imbalances.
So there are many, many routes to innovation and to follow. We've last year, after the speech of your cookies, we already saw the writing of a blockchain covered bond on the wall. We're still not there yet, but again, you heard it here the second time now. So I would love to love you to join me in thanking this distinguished panel. And it's there's many topics that we can follow up on. Thank you very much.